Hello, I'm Nick, and this is going to be an academic approach to Marketing Monday. Marketing Monday is a recurring Twitch and YouTube segment that live streamer Atrioc does, where he goes over recent updates and any interesting events happening in the world of economics or marketing, uh, anything interesting in finance, any new things happening between China, Europe, and the US, various stuff like that. However, because he is streaming to a pretty broad audience and he doesn't know what his audience's educational background is, he has to keep it, one, pretty focused on the entertainment side of things, and then two, he can't go into uh, a ton of depth into what and why things are happening, especially with regards to any uh, mathy stuff, which is what I in particular enjoy, especially when it comes to game theory and incentive problems with what people are doing and why. So that's what this video is going to be about. It's going over his most recent Marketing Monday, uh, and going in depth into some of the stuff I found most interesting about it. Uh, I will try and give as broad of an update or build up any prerequisite knowledge I think may be needed, especially around game theory, but a pretty basic understanding of statistics and economics would also be a bit beneficial to this. Uh, Maybe not this video in particular, but if I continue to do these, I may go a bit more in depth. I will include timestamps and sources in the description, and if I get anything wrong, please correct me. And if there's anything to discuss, please, you can get me on Discord or in the comments, and love to talk about it. So the first thing we're going to be going over is what game theory is. And to do that, I'm going to be using what's probably the most well-known game in game theory, uh, which is the prisoner's dilemma. Here you have two players who are given a starting condition of they've committed a crime and they need to either confess or not confess with the police. Uh, and they need to find their own optimal decision, disregarding the other players. Now, the societal best outcome for these two players is to both not confess. However, if you look at an individual level, confessing is always better for that person, which leads to both players deciding to confess and they both go to prison for a long time, which is societally pretty bad. It's good for society, but for these two players, it's pretty bad. This is known as a simple form game because both players make their decisions simultaneously. Everything is out in the open. Uh, so this leads into what Atrioc had mentioned, which I want to talk about, which is a viewer had talked about how he was 2 years into college and he really didn't want to or care about finishing all that much. Atrioc said, just get the degree, put out your 2 years, and it will most likely turn out well for you. Better than if you quit now. And the reason is you can model as a game, uh, an extensive form game, so the with multiple turns, and there is also asymmetric information. You can consider this game's set up to be that there are two people or two entities, two players, a company, and a job applicant. The job applicant is one of two types of people, either an efficient or an inefficient worker. And the company wants some way to differentiate between those two types of people. And the easiest way to do that is by the applicant implementing a costly signaling strategy. Uh, and the costly signaling strategy is going to be going out and putting in the effort to get a college degree, because if they're an efficient worker, it's going to be much easier for that person to get a college degree. The company, because there's asymmetric information, doesn't know if you're actually an efficient worker or not. All they can see is, oh, he did or didn't get the degree. And so they are going to pay more, which is known as informational rent, or information rent. They're going to pay more for that knowledge if they're able to, with certainty, determine that the degreed person is a more efficient worker, and that no inefficient workers will ever have a degree. You can see here, these are the probabilities. This is known as the nature of the player A, being or not being an efficient worker. And you can see that if they're an efficient worker, regardless of whether or not they have the degree, they will produce an extra 3 units of output for the company if they're hired. However, to get hired, it's easiest to, not in this scenario, but it would be easiest if the non-degree hired outcome was lowered by 1.25, then it would be better for the efficient person to go and get a degree, because they would earn more. They would be hired at a higher wage. And this is known as a separating equilibrium, because you're able to separate, not in this game, but you're able to separate these two different strata, the efficient and the inefficient workers, by changing what the payoffs are for people at the end, and making it worse for the inefficient worker to get a degree and better for the efficient worker. Atrioc had also mentioned that he thinks banks are going to continue to collapse, and that gets into something that he has hinted at a few times, but hasn't ever really been able to go in depth into, which is reserve ratios. So banking failures can kind of be narrowed down into 2 types. They're tangible, permanent losses that lead to pretty immediate collapse or pretty quick collapse in banks over the course of, let's say, 1-2 years. And then there are impermanent losses where, if they are recognized, can cause a collapse in days. Or in the case of Silicon Valley Bank, I think it was literally a day or a few hours, if I recall correctly. And a better term for these would also be insolvency and illiquidity. So in 2008, most of the failures were caused by permanent tangible losses that the banks had suffered on mortgages and loans based off of home equity, that ended up failing when housing prices went down. Because as the prices went down, the collateral that was used for those loans, which was the house, were taken back and sold on the open market, which led to an oversupply of housing. Housing prices went down, and that led to further falling of the value of collateral on currently surviving loans, which meant that once the housing values that were serving as collateral fell below the actual mortgage value, the banks called back the loans, and when the person couldn't pay off the mortgage immediately, the bank took back the house, canceled out the mortgage, and relisted the house. And that kept going in a cycle, causing, and as a result, lower housing prices or falling housing prices led to further falling housing prices. Impermanent losses, such as what happened in 2023 with rising interest rates, are typically involving rising interest rates and what's called duration. And this is based off of the principle that in order banks, one of the main ways they make money is net interest earned, or taking in deposits. Let's say they pay 1% in interest on deposits that customers give them, and then the banks will go out and lend the deposits out at, let's say, 2%. So they take money in at 2%, lend it, pay it out at 1%, and they keep that net 1% interest. Now, this works fine as long as interest rates remain stable. However, uh, the Fed has recently raised interest rates pretty dramatically in order to fight inflation. Um, but before we get into that, a reserve ratio, which I wanted to get into, uh, is an amount of money, an amount of cash that the bank needs to hold on to relative to the total deposits that they have. And so here the example is if a bank, or if the Fed, the Federal Reserve, sets a reserve ratio of 0.1, then a bank needs to have 10% of the deposits that are given to them in cash at any given time. The rest of it, they can do not whatever they want, but they can go lend it out. Uh, so FRB, First Republic Bank, let's say that they had $100 in customer deposits at a 0.1% reserve ratio. So they lent out $90 of that 100 in 5-year government bonds. Let's say that the bonds didn't pay. They were zero coupon, so there were no dividends associated with the bonds, and they were initially purchased at 0%. If those 0% bonds that were dated out for 5 years had interest rates go up to 5%, then the banks would take a 21, 22% loss on them, and their original $90 would immediately become worth about $70, 70.52. Because of the Fed basically being like, you don't need to mark down losses on federal bonds. They don't have to really do anything with it. They can just keep holding on to it as long as they don't plan to sell them in the interim. However, they now only have 70 plus 10, they only have $80 of assets corresponding to their $100 of liabilities in customer deposits. So if their customer realizes that, then they don't want to be left holding the bag, having to deal with the FDIC or the insurance that the bank had purchased. So they're going to immediately go pull out as much of their money as they can, but there's only $80 left, which means that the bank ends up collapsing. And that impermanent loss, if they had held onto this 5-year loan, this 5-year bond for the full 5 years, it would, at the end of the 5 years, be worth $90 and they'd have their $100 back. But they have to lock in their 20, this should say 21, but they end up locking in their 21, 22% loss because they have to sell to meet customer demands and maintain their reserve ratio. And then another restriction that I think is pretty interesting are the Basel Accords. There are currently 3. This is the first Basel Accord, and they have to. It basically dictates that the riskier the asset that the bank invests in with customer deposits, there's a limit to how much their risk they're allowed to take on. And so federal bonds are essentially risk-free. There's no chance of the government not paying them off. So they have a risk weight of 0. Let's say you have a risk maximum of $10. If you put uh, let's say $50 into claim on it. Let's say you put, I said $10. So let's say you put $20 into giving out residential mortgages, then you would be at that 10%. You would be at that $10 limit, and you wouldn't be able to buy any other risky assets because the risk weight of 20 times 0.5 would be at your $10 maximum. So you're now only allowed to hold risk-free or zero risk weight assets, such as cash or U.S. treasuries, and bonds and stuff like that. Furthermore, Atrioc was talking about debt ratings. It's kind of a non-issue, in my opinion, for right now at least, that Fitch ended up downgrading the U.S. to, I think it's AA plus, AA plus, which is one below the maximum of AAA. Although the U.S. got downgraded, it's still used as what's called the risk-free rate, which is any bond or any debt issued based on U.S. dollars is going to use the is going to use government bonds as the risk-free rate, and then they're going to add an appropriate risk premium onto that risk-free rate. So let's say and then they base that risk premium off of the implied default risk, and then what the recovery rate is for that given default scenario. But it's really a non-issue. The U.S. is still used as the risk-free rate. There's only one company rated higher, which is at AAA on behalf of Fitch, and that's Fannie Mae, which is effectively a bank run by or backed by the U.S. government. So it's kind of like saying that, oh yeah, the U.S. government is only AA plus, but this thing that they're guaranteeing is AAA. And then there's also Microsoft and J&J, Johnson & Johnson, which have AAA ratings with some other credit agencies. But it's a bad sign, but it really doesn't have... It's costless signaling. There's no real meaning behind it. There was also a bit of talk about the difference between Douyin and TikTok. Douyin is basically the same as TikTok. It's just TikTok in China. And you can access it from outside of China. Right now I'm in the US, and I'm able to go on to the website. And there's a bit of a difference in content.
你懂什么？我这个叫 cosplay， 懂不懂呀？还有啊，要说谁怂？看到这大钻戒了没？啊，他给我专门定制的，有吗？你有吗？有吗？你有吗
？Relative on which relative to TikTok, which is much more heavily focused on the short form content. But I'm also not signed in, so it could a representative sample, obviously. But yeah, they're basically the same platform, just different languages and different locations. They're both handled by the same company, everything like that. Oh yeah, and this is just going back to debt ratings. Yeah, the US got downgraded. Doesn't actually mean much. Credit spread hasn't changed at all. It's still at about 2%. The credit spread is the difference between difference in yield between the U.S. risk-free rate and a certain class of, here it's BAA corporate bonds. So currently, corporate bonds at that rating are going to be about 2% higher than the risk-free rate, the 10-year treasury. Atrioc also likes to talk about how there's an upcoming recession, which I won't get into too much, but he thinks the basis of that is that there's a high revolving credit balance, especially with credit card debt, Student loan payments are going to be resumed. Uh, Somebody had mentioned the employee retention credit fraud, which is significantly worse than the PPP loans, because instead of being a check that the government can investigate, that the government themselves cut, the ERC is literally just a tax credit that is given out, um, that people can claim or businesses can claim, but there's no real accountability for it. Uh, Atrioc has mentioned sticky inflation, and then he went on to mention uh, gas prices hurting the CPI. Energy, I say it here, but energy isn't included specifically because of how volatile it is. It goes up, it goes down. The US still has a huge amount of oil reserves. Not that we should be depending on it, but it's, I'm hesitant to agree that inflation is going to shoot back up all of a sudden. Um, he thinks that there's going to be more bank failures, which I don't really agree with, but there are reasons to think so, especially because of the risk that is posed by by lenders essentially not being able to pay back, having a 2008 scenario where lenders aren't able to pay back loans that they've taken out, uh, especially at very low interest rates. So there's a huge principal loss for those banks. And then office real estate values plummeting because work from home never really fully went away. I think most cities are kind of peaking out at like a 75% return to office. Because of that, the companies are struggling to actually claim that their office real estate is a performing asset. So, yeah, if they were claimed as a mortgage, then the value goes down. They have to sell off the asset. The actual value itself uh, of the building gets marked down, which leads to paper losses uh, on the accounting of the office or of the company. And then here are some graphs about going over why I don't think there's a super significant risk regarding credit card debt, for instance. Yeah, it went up a bit. It hit 1 trillion, but I mean, not not a whole ton. Home equity went up, which I think just this month, we had our first ever month of uh, home equity loss in value. So this could be considered a bubble. Not super great, but what are you going to do? And then you can see here the relative sizes of these debt categories. Credit card debt has pretty much stayed the same, hasn't changed at all. The only thing that has changed over time are student loans, which haven't been really considered. Like, we haven't had to make payments on student loans for a few years. I think payments are resuming in October. I saw an article recently saying that over half of student loan borrowers are going to have to decide between paying off student loans and paying buying groceries, which I'm hesitant to fully believe that, but I guess we'll see in a month or two. Here you can also see the actual required the debt service payments, so just paying off the interest and maintaining your debt schedule has gone down significant. It's nowhere near where it was prior to the '08 crisis. We're still well below those levels by 3-ish%, 4-ish%. Granted, I'm not sure if this is including the student loan payment halts, but even if it is, that's only going to account for a slight increase in payments. Here we can see the net unrealized. These are the impermanent losses that I was talking about. As long as the prices go back up, I guess. So, available for sale securities such as, well, yeah, whatever. And then what's owned by the large large commercial banks. And here you can see for the first month since 2012, 2013, the median price of sold homes has gone down. And then just some random stuff that I wanted to address. I don't think anybody will like Jerry TT will see it, but while recessions tend to lead to a decrease in economic equity, yes, so there is a paper where, and I just think this is more interesting than applicable in real life, but retail traders are slow to pull their liquidity from markets, and so they're actually able to earn a pretty significant, I think it's 10 or 15 points of alpha annualized within a 2 week period of excess volatility where there is a market crash. Funnily enough, not funny, but retail traders don't actually capture that alpha. They just end up losing it. So they kind of just serve as a buffer for larger traders to get in or get out and then get back in, which is kind of sad because they're taking on a lot of additional risk for money that they don't get. A guy named Jerry TT had asked why YouTube allows TikTok to advertise on their platform. There's a few reasons, such as diversification of revenue and collecting data on who TikTok sees as their clients, who Google collects the data because they own TikTok. But the biggest, I think, is that they want to prevent claims of they want to prevent antitrust actions. As a related case, Microsoft back in the 90s, I think, was sued by the Department of Justice because they were bundling Internet Explorer with their computers and they were making it difficult for customers to actually switch browsers, I think was the main example cited. Specifically Netscape, I think, was leading the charge on this. We can see how well Netscape did, but yeah, so this is this is my first academic approach. I don't think I had anything else I wanted to talk about. Yeah. So hopefully this works out well. Oh, golden parachute. Atrioc was talking about the WeWork CEO. A golden parachute is basically you're getting kicked out of the company, but you have your contract set up so that when you get kicked out, the company has to pay a huge severance to you. You don't lose a ton from your vesting schedule. You end up, even though you're getting kicked out for poor performance, you get a lot of money regardless. So yeah, hopefully this was interesting. I'll see if I want to do more. Yeah, thank everybody for watching.